The biggest news around the housing market here in the United States over the last 2 years has been the huge spike in mortgage rates. Now, mortgage rates, for everyone's basic understanding, will always trend the exact same direction as inflation. So since inflation became a little bit better known than just a household term about 2 years ago, mortgage rates followed directly behind it. But basically, late last year, mortgage rates eclipsed a 25-year high. Obviously, that's not happened in some time. I've been in this career for 23 years, so these are definitely the highest rates that I have seen, but they also present massive opportunities. Now, most people falsely assume that lower mortgage rates somehow equate to a more healthy housing market, and that higher rates mean that it's a terrible market. But the opportunities always lie in wherever there is some misinformation. And let's be honest, guys, when we had lower rates, historically low rates, in fact, never been seen before lower rates during the COVID market, there was nothing healthy about that market cycle or dynamic. Homes were selling in minutes, people were lined up around the block and paying ridiculous sums over the asking price just to get a home. And in some markets, people were buying the house without even visiting it or seeing it. Now, this is crazy and there's nothing healthy about that. And that was with lower rates. So yes, while rates have gotten higher, affordability has been hurt. And we do have other systemic things that are making housing more challenging, such as the lack of inventory and a very negative media that is constantly trying to tell us that housing is about to collapse. But with those higher rates are huge opportunities, and that's what today's video is about. Now, currently rates are above the 7% threshold, and if you don't believe or understand the impact that higher rates can have on affordability, take this into account. For a sample size home of about $500,000 with a reasonable down payment, a 7% rate would probably leave you with an overall total monthly payment of about $3,000, including taxes and insurance. That same home, if it was purchased the same price, but at an interest rate closer to 4%, would be cheaper by a little bit more than $400 per month. So obviously that has a big impact. And for first-time homebuyers especially, who are very, very rate sensitive and really want to keep their payment at or close to a particular budget, the mortgage rates really do matter. And that swing of $400 could mean the difference between getting the home or having to sit and wait out the market. Now, of course, there's always some buyers out there that are a little bit more immune or cushioned to some payment variance, but most Americans, particularly first-time ones, are going to be very sensitive to mortgage rates. So how is it possible to get a lower rate in today's market? Because let's be honest, they're not coming down anytime soon. Every time we thought we were going to get lower rates here in the United States, some negative news or geopolitical events sent them straight back up. So rather than waiting for them to come down naturally, there are some ways in which you can actually try and either negotiate or tactically apply strategies to get a lower rate in today's market. So those strategies range from being really simple to a little bit more sophisticated, and today's video is going to get into that. My name is Arjun Dhingra, and I have had 23 years experience helping first-time buyers be very smart and intentional about the mortgage debt they're taking out so that they can build more long-term wealth and build their real estate portfolios. I am a two-time Taekwondo world champion, the former co-head coach for Team USA. I live here in Northern California with my wife and two beautiful daughters and really enjoy bringing this kind of content to the marketplace. So if you are enjoying watching this video so far and you've seen other bits of my content, please do me the favor and subscribe to this channel and make sure to like this video so that I can reach more first-time buyers or people that are curious about entering into housing like you. So let's get into it. The first age-old strategy of how to get a lower interest rate than perhaps what the market is offering you is to, the good old-fashioned word, negotiate. Now, negotiations are always fluid, and any interest rate or product is always negotiable in the mortgage space. Now, a word of caution to you, because many people treat a mortgage transaction kind of like a used car sales deal, where you will shop around and try and race to the bottom, meaning you'll pit various lenders against each other to fight for and earn your business. I'm of a little bit of a different mindset when it comes to this, because I do understand that a low rate is very important, but it's not the end-all be-all, because the right mortgage strategy paired with a very competitive interest rate will always be better, 10 out of 10 times, be better than the lowest rate that is paired with the wrong strategy. Because at the end of the day, any rate you want is attainable. It just comes down to cost. But how do you mitigate those costs? Well, this first option through negotiation would be to call up a number of lenders and try and negotiate the best possible rate for yourself, or try and find something that's a little bit lower than perhaps what the headline rate is that you see online or what's being talked about weekly in the media. On any given day, a mortgage rate will be different from one lender versus another. And they also have various pricing structures or particular adjustments that may be part of that interest rate. So you'll want to do a lot of legwork in terms of asking serious questions of that lender, trying to figure out how they arrived at the rate that they did, and then taking this around. The downside to this type of a goose chase is that you're going to spend a lot of time and a lot of effort for what ultimately in the end may be a very, very small difference in rate. My suggestion to you would be to find a lender that is very, very proven and time-tested in not just this current market, but in previous market cycles. And also someone who is very strategic, particularly a mortgage advisor, as opposed to just some transactional mortgage lender. There's a big difference there. So while negotiations are probably the most time-tested or the oldest and traditional ways of trying to get a lower than market rate, I caution people against going too heavy into this particular space because of the amount of time that it may spend and not yield you necessarily the most incredible or satisfactory results. So the next simple option in terms of how you can get a lower rate would be to increase your down payment. Most all lenders and loan products have some variance in terms of when they start to peel back certain cost overlays or pricing adjustments when you put down a larger down payment. So when we go beyond 20%, such as 25, 30, 40, even 50% down, then you can actually start to see some dramatic improvement in rates because the risk is so much less for a bank when there's more skin in the game from you as a would-be buyer that they're willing to offset that by offering you a bit of a lower rate. It doesn't necessarily always amount to a favorable interest rate when you think about how much more capital you're having to put into the deal, but this definitely does make a difference. The next simple way to try and get a lower rate in today's market would be to take on an adjustable rate mortgage or an ARM. Now, ARMs got a very bad rap from the early 2000s market because a lot of them had adjustable caps on them, meaning how much the rate could potentially go up to, or a maximum threshold that were very different from today's market. And there wasn't a very thorough qualification process to ensure that you, as the person that is taking out this adjustable rate mortgage, would in actuality be able to afford the payment in a worst case scenario when it does inevitably adjust. But here's the reality of adjustable rate mortgages, and this is coming from someone that is not only a big advocate of them, but actually has one. In fact, I'm in the 7th year right now of my 7-year ARM, which means I've got to try and find some way to refinance in this high rate market. You see, the average homeowner in today's market is only going to be in their home for about 5 to 7 years, mainly because life, jobs, or other circumstances are going to dictate them moving a little bit more frequently than, say, our parents' generation did, who typically only bought 1 or 2 homes in their lifetime, and they stayed put. And despite that movement or migration pathway, the current homeowner in the United States is refinancing every 3 to 5 years. So while you have people moving every 5 to 7 years, you've got refinancing or restructuring the debt taking place every 3 to 5 years. And this current market cycle is not going to be any different with lower rates on the horizon. So while a 30-year mortgage is considered to be very traditional and safe and conservative, the trade-off for taking either a 5, 7, or 10-year adjustable rate mortgage, especially if it's going to get you potentially lower rates by as much as 0.75% or even 1% during certain market cycles, is well worth it because they're giving you this lower rate in exchange for your risk of only keeping the mortgage potentially for a much shorter period of time. Now, nothing negative happens at the end of that fixed period term, whether it's 5, 7, or 10 years. It just will adjust to the terms or the limits that are set forth by the contract when you're actually locking in this rate and program. But for most strategic buyers, especially if their plan is to only stay in a starter home for just a few years, these mortgages make a lot of sense. And you don't want to anchor yourself to a 30-year mortgage that you're not going to keep for that long anyways. So yes, there is risk attached to these types of loans, but the trade-off and the reward that you're going to get for having a shorter fixed term period in most cases is well worth it, but you want to be very educated about these products. And again, make sure you talk to an actual mortgage advisor and not just some e-lender or someone operating from a call center that is reading off a script. Okay, now let's start to get into some of the more sophisticated strategies and some that we're seeing a lot more of, especially this last year in the market. The first one is going to be buying down your interest rate. Now, there's a few combinations and ways in which you can do this. First, we'll start with just you as the buyer. You can always pay money in exchange for a lower rate. This is called paying points or buying down your interest rate as a buyer, meaning the money would come from you. Now, the typical trade-off is that for every percentage point that you pay, and let's just use a classic example that if you financed $500,000, meaning that was your mortgage, every point, meaning 1 point of that would be $5,000. $500,000, 1 percentage point, $5,000. So so on and so forth. But the rule of thumb is that for every point, you can typically reduce your interest rate by roughly about 25 basis points, sometimes a little bit more depending on what type of market cycle we are in. Now, during COVID, this trade-off was absolutely phenomenal. Whereas in many cases, if you paid a point or even 2 points, you could sometimes discount your interest rate by well over a percentage point. But in the current market cycle, I think that conservative rule of thumb of at 1 point for about 0.25% reduction in rate is a safe one to assume. Now, it does start to taper off, so you can't just continue to play out the math the way I've said it to you and think, well, if I pay 4 points, I'll get my interest rate knocked off by a full percentage point. It may not actually add up that way. In fact, after the first or second point, we start to see a little bit of a taper off in terms of the impact or the actually buying down capacity or power that you would get. But for someone that's looking to have an immediate and quick impact on their interest rate, they could pay a point, maybe 1.5 points to try and get their interest rate reduced by a decent amount. And another thing to keep in mind is, especially at the time that you are purchasing a home, these types of points or cost structures can be tax deductible. So for people that are trying to think ahead or more strategically in terms of their taxes, a buy down that is paid for by them when actually purchasing the home can make a lot of sense. Now, the other way your interest rate could get bought down is by way of a concession, meaning you have the seller actually do it. Now, we are in a market, and this is because of higher interest rates, where the word negotiation is actually part of the dialogue. During the COVID years, you could not negotiate anything. In fact, many sellers would not even be sitting at the table while your offer was being considered because their agent was instructed to take the most ridiculous and highest offer that was being put forth, and then everyone would celebrate afterwards. But now, because we're in a higher rated market, transaction volume can be slowing, and sellers are equally as nervous as buyers about these high rates. Sellers are a lot more amenable to sitting at the table and hammering out a deal. And in most of those cases, they will do either a price reduction or offer you some sort of a concession to keep you very enticed into wanting to buy their home. The best example I can give you of this is with new construction. New construction commodities are totally different because builders are able to package their product in a very customized way to move it. Their product is actually built to move, whereas existing inventory is just the way that it is, and it also comes with the current owner's way and style of having marketed that property. Sometimes they're living in it, so it's a little bit of a different nuance. But with new construction, many builders who actually own or are partners in their own mortgage company, which is why when you actually visit a new construction development, you have to get qualified with their lender on site. Just remember that in most cases, they actually own or are a partner in a joint ventureship with that mortgage company. But this actually can work out to your advantage because these builders are very incentivized to want to move this product, and they will sometimes already offer to buy down your interest rate by contributing 1, 2, or even 3% towards the use of purchasing down your rate, or they will actually buy down the interest rate for you to a certain point as a form of a special offering. But when it comes to existing inventory, if you're sitting down with your agent and they are sitting across the table from the seller's agent, they can negotiate a certain amount that could be credited back towards your closing costs as a buyer. That money can actually be used to either offset those transaction costs, which can be quite expensive in most markets, or you could use it to actually buy down your interest rate. The decision is entirely yours, but one that you do want to discuss with your lender because there are certain caps and provisions in terms of how much of an interest rate buy down may be allowed, and also what is intelligent use of this money. In many cases, if it's not going to give you a big return in terms of a big reduction in monthly payment, it could be smarter to use a credit that's being given to you by a seller to actually offset the closing costs that are involved in the transaction, for which there's no real tax benefit in paying in the first place. So sellers can help buy down your interest rate. You can buy down your interest rate, but another creative way in which a seller could get involved to help you really get a lower rate are with either 2-1 or 3-2-1 buy downs. Now, there's a little bit of nuance to how these actually work, and you'll want to check out my other video here on my YouTube channel about how 2-1 buy downs actually work and what is the math behind them. But in real simple terms here, the seller is to give you a certain credit that would be used to basically buy down your interest rate from whatever the current market rate is, in the case of a 2-1 buy down, to be 2% lower in year 1 and then just 1% lower in year 2 before returning to what the rate would have been in year 3. And in a 3-2-1 buy down, it's 3% lower for year 1, 2% in year 2, 1% in year 3 before returning to what the original market date was. Now, these are absolutely not to be confused with adjustable rate mortgages, because these are not adjustable. They are actually just specially packaged rates that are set at lower than market rates to allow you much more affordability in the early stages of living in a home, because the banks and the housing industry does understand that at some point within that 2 or 3 year period, an opportunity to refinance or restructure your mortgage debt is going to be there anyway. The last way to get a lower interest rate today that I want to share with you guys is through actual seller financing. Now, this is really rare, but there are some situations where this can apply. And you want to make sure that you're asking the right questions or having your agent ask the right questions. A lot of sellers that are in today's market are actually being faced or looking down the barrel of a significant tax bill. Because there's been so much record appreciation over the last 10 years in most all housing markets across the United States, many sellers are going to be faced with not just a nice windfall of profit when they sell their home, but a huge bill from not only their state, but also our favorite uncle, or not so much, Uncle Sam. So capital gains can kick in, and a lot of sellers are very wary of this and they want to try and avoid it. So this is where seller financing can be a big win for everybody involved. Now, again, this is very rare, so you want to make sure that your agent or you are asking questions of sellers as to whether or not they might entertain this, and it's going to depend on their exact situation, their household finances, and potential tax liability that they would be facing at the end of this. The key factor I would look at if I was trying to find a seller that might entertain this is for someone that has lived in a home for a very long period of time, meaning at least 10 plus years, which means they're probably sitting on a lot of equity, a lot of future upside once this home sells, and they're inevitably going to face those consequences of capital gains when they do in fact move that property over to you. So what you would do is approach the seller, and the beautiful thing about this is it's a free and open market. You can come up with whatever terms you want. Now, the reason why this is a win for the seller is because you would approach them, make them an offer, and if they are open to the idea of seller financing, you could put down a down payment, of course, which would go to them, because you need to think of them as now the bank. You wouldn't need a mortgage guy. You're dealing directly with the seller who's going to hold your loan. Now, they would probably use a servicing company or come up with some arrangements that are very legitimate and on the up and up and fully transparent for everyone when it comes to making payments and keeping records. But you would approach them, come up with a down payment strategy, negotiate an interest rate, perhaps some closing costs or other incentives attached to the seller for doing this special deal for you, and you're off and running with making payments. There's also still a way to make sure that this is reported to the credit bureaus so that you are getting credit for making on-time payments with this mortgage. And of course, you would be the legitimate and legal owner of that property. It's just that instead of paying a mortgage bank, you're paying the seller. Now, for a seller, they might like this because they can now start to generate monthly income. If they don't have an immediate need for that actual sum of cash, meaning from actually selling the house and getting all of that profit or upside, they might be totally okay with moving on and treating this house almost like an investment vehicle, to where every month the payments you are making to them are actually paying them a nice rate of return, until eventually you might decide to refinance when rates get lower and put the loan in your name, and the seller would be paid off in full at that point. So while this is totally different from getting financing with a bank, it can be an absolute win-win for everybody involved, and it functions and will be completed just like a normal real estate transaction in the absence of a bank, because the seller now becomes the bank. Again, these are very rare, so you want to actually seek them out. They're going to be so much driven on a case-by-case basis. But if you're asking the right questions and looking for the right types of homes that have been occupied and owned by the same person or party for at least 10 years, there could be a window to where this could work and actually create a win and some income from an investment standpoint for the seller. It gets you into the home at totally negotiable and non-market interest rates and terms, and the agents involved in the deal will still get paid out the way they would as long as it's been properly negotiated. So those are a number of strategies, and of course there's some more, but these are the most important and common ones that I see in today's market as to how to get a lower rate than what you're seeing out there in the mainstream media or what's being advertised online. I'd love to hear your guys' feedback and thoughts on this, if you've ever engaged in a transaction like this, or if you agree with some of these strategies or want to learn more about. Make sure you drop me a line or a comment here on this video. I will try to respond to every single one of them. If you do have a serious question about wanting to learn more or how you can actually put one of these strategies to work for you, you can always visit my website at any time, which is arjundhingra.com, and put in an inquiry there, and I will be absolutely sure to get back to you and help you out with any kind of strategy that you're looking to put forth in applying how to buy your actual own property here in the United States. We do lend in 30 plus states, so chances are we would be able to help you, and it would be an honor to do so. If you are looking to move to the area or make any part of the San Francisco Bay Area your home, make sure you check out my website and send me a note so that we can be in touch. I look forward to seeing you guys on the next video. Thank you so much for watching.